Howdy, everybody. Welcome to Liberty Call. Today is January 8th, 2025. Hope you're having a fantastical day out there. So far, the news is the Fed's Christopher Waller is backing more rate cuts this year, even with inflation and new tariffs on the horizon. Citigroup CEO remains under pressure as analysts watch closely, and Warren Stevens is stepping down to take on an ambassador role, handing his family's investment bank to the next generation. Meanwhile, China's official GDP numbers are being questioned again, and Scotland's own cryptocurrency, Scott Coin, is planning a major exchange debut. Lots to cover today, so let's go ahead and dive in. But before we do, I need your help. If you could give me some thumbs up, a like, share, subscribe, and follow, and press that notification bell. All right, let's hop over to the markets. Hey, they finished in the green. The Dow Jones was up 0.25%, 106 points, closed at 42,635. S&P 500 up 0.14%, 8 points, closed at 59.17. NASDAQ down 0.07, 13 points, closed at 19,475. The VIX was flat today. It's at 1770. Canada up 0.49, Brazil down 1.27, and Mexico down 0.79. Over in Europe, Germany was flat, down 0.05. UK also flat, up 0.07. Let's see here. France down 0.49, the Netherlands down 0.55, Spain down 0.12, Italy up 0.49, Switzerland up 0.25%, and Portugal down 0.46. Russian exchanges, again, they're both the same, which is weird. Both of them were up 0.88%. And moving on to the overnight markets, the Nikkei in Japan was down 0.27, Australia up 0.77, New Zealand's flat at 0 right now. Let's see here. The Shanghai was up 0.02, Shenzhen Component down 0.54, China 50 down 0.19, DJ Shanghai down 0.05, Hang Seng down 0.86, and the Taiwan weighted down 1.03%. All right. So those are the markets. Let's get to the market recap. S&P 500 flat as tech continues to stumble. Fed minutes signal slower rate cuts ahead. And we'll get to that in a minute. All right. U.S. stocks remain flat on Wednesday as technology stocks continue to weigh on the markets, while the Federal Reserve's December meeting minutes signaled a slower pace of rate cuts ahead. The minutes from the Federal Reserve's December 17 to 18 meeting revealed that policymakers favor a cautious approach to further rate cuts due to concerns about stalled progression in reducing inflation. Fed members noted slower progress in bringing inflation closer to the 2% target, prompting discussions on slowing the pace of monetary policy adjustments. Moving on to tech stocks. Despite steadying treasury yields, tech stocks struggled to recover from Tuesday's sell-off. Major players like Apple, Alphabet, and Meta traded lower, while NVIDIA remained near the flat line. Planeteer Technologies continued its downward slide, falling further amid concerns over high valuations. The stock has dropped around 16% since reaching a record high last month. Employment data showed unexpected strength, with initial jobless claims falling to 201,000 for the week ending January 4th, marking the lowest level since February. The 4-week moving average also declined to 213,000, down from the prior week's 223,250. Meanwhile, private payrolls increased by 122,000 in December, following a gain of 146,000 in November, according to the ADP National Employment Report. These positive employment figures, combined with earlier reports of rising job openings, strengthened expectations that the Fed will hold off on additional rate cuts in 2025. Investors are closely watching Fed Governor Christopher Waller's upcoming speech for further insights into the monetary policy. And finishing up here, ExxonMobil fell 1.5% after warning that a drop in oil refining profits would reduce fourth quarter earnings by $1.75 billion. Rival Shell also declined 2%, citing a $1.3 billion charge related to permits and weaker earnings in its gas division. All righty, good stuff. Let's hop into some data. This report came out late yesterday. The December ISM Non-Manufacturing Index. This was put together by Nate Guernsey at First Trust. All right, the ISM Services Index ended the year strong, rising to 54.1 in December, beating expectations and showing resilience compared to the struggling manufacturing sector. 14 out of 18 services industries reported growth, with only 3 industries, mining, real estate, and educational services, contracting. The rise in the index was driven by robust business activity and new orders, which both sit comfortably in expansion territory at 58.2 and 54.2 respectively. Survey comments indicate optimism for 2025, though some companies are delaying capital projects until more clarity emerges on policies from the incoming Trump administration. Hiring in, hiring in the services sector remained balanced, with the employment index steady at 51.4, equal numbers of industries reported employment gains and losses for December. Inflation remains a significant concern, with the prices index hitting 64.4, the highest since early 2023. Survey responses noted worries about potential tariffs impacting prices, though inflation has been a persistent issue even before new tariffs. In December, 14 industries reported paying higher prices, with only agriculture, forestry, fishing, and hunting reporting lower costs. Although the Federal Reserve's monetary policy remains tight, with the M2 money supply down 1.3% from its peak in early 2022. It went up 40% from 2019. So going down 1.3% isn't that much. Rate cuts since September have eased conditions slightly. There was concerns that aggressive rate cuts or Treasury drawing from the Treasury general account could increase M2 supply, reigniting inflationary pressures. Overall, the services sector continues to support U.S. economic growth despite inflation risks and policy uncertainties. All right. And as promised, here is the minutes from the Federal Open Market Committee from December 17th to 18th. We're going to read through a quick summary of this and see what they had to say. All right. The Federal Open Market Committee met to discuss developments in financial markets, economic outlooks, and monetary policy adjustments. Key highlights include rising Treasury yields, slower rate cuts, labor market stability, and inflation control. Financial markets and Treasury yields. Treasury yields fluctuated, with nominal yields rising slightly since November. The 10-year yield increase was driven by real yields rather than inflationary concerns. Market expectations for federal funds rate cuts were unchanged, with a 25 basis point cut expected at this meeting. The FOMC acknowledged uncertainty about the path of rate adjustments in 2025. Balance sheet reductions are expected to continue through mid-2025. Globally, other advanced economies are reducing rates, contributing to a stronger U.S. dollar. The committee noted stable money market conditions, though repo rates could rise around year-end. The Fed's overnight reverse repo agreement on RRP facility usage declined, but year-end dynamics may increase balances temporarily. The committee planned additional standing repo facility auctions to manage market pressures. Real GDP growth remains solid, with labor market conditions easing. Inflation slowed, with consumer price inflation at 2.3% in October. Core inflation remained above 2%, but both measures were lower than a year ago. Jobs gains were steady, and the unemployment rate increased slightly to 4.2%. Exports and imports saw growth, though foreign economic growth weakened in late 2024. Inflation expectations showed mixed signals. Near-term inflation compensation rose, while long-term expectations were stable. Equity markets rose on optimism about corporate profits, while foreign financial markets showed weaker performance. Borrowing costs for households and businesses remained elevated despite declines in mortgage rates. Credit availability for small businesses remained tight. The FOMC decided to reduce the federal funds rate target by 25 basis points to 4.25 to 4.5. Members noted inflation progress, but acknowledged ongoing challenges. Some participants preferred holding rates steady due to inflationary risks. The committee stressed the need for cautious, data-driven adjustments in 2025. Participants discussed the risk to employment and inflation goals. Upside risk to inflation included stronger consumer spending and potential trade policy changes. Labor market risks were seen as balanced, with gradual easing expected. Participants highlighted the importance of a gradual policy approach given economic uncertainties. And finishing up with their actions, the FOMC reduced the federal funds rate by 25 basis points, maintaining a cautious stance. Sure. The committee pledged to monitor economic data closely and adjust policies accordingly. One dissenting vote preferred keeping rates unchanged to address today's inflation concerns. And the next meeting will be held on January 28th and 29th of this month. All right, so that was the Fed meeting minutes. Pretty exciting stuff. Not really. So if you want to read it in its entirety, it is linked in the show notes, so you can click to that. And if you have trouble falling asleep, it will definitely do that for you. All right. Well, that's everything I had to cover for today. If anyone needs anything from me, please go to DSAFinancialGroup.com. All your financial planning needs can be addressed there. So give me a call. I'd be happy to help get you on track. All right. Well, like I said, that's everything for today's news. And hope everyone out there has a wonderful evening, and I'll talk to you again next time. Adios.